142 jobs, 1,000 jobs added this week. I mean, this month. Can you really trust the data? I mean, it's really hard at this point. Unemployment rate ticked down to 4.2%. This isn't surprising. This is a household number. If you sold over $600 on eBay, which if you lost your job, you might do, you might be considered employed.
Yeah. It's the gig economy. They can say, hey, gig economy, and $600 is what roughly, some of the unemployment rates are, or payments are from some states is about $450 to $600, if I recall. And so, yeah, that's therefore it's like you're getting paid more than what you would have got paid if you're collecting unemployment checks. Yeah. And so anything from there on, they are counting it. They're saying, yep, you're good. You have a job.
Yeah, I just sold my bike on eBay for $700. Okay. I got to report it. So my household, yes, I'm employed. I sold my record collection. I hawked my child. I don't know, whatever the case is, right? You sell something over $600. Is it $699? You're
my childhood dreams, and I hawked my childhood dreams and memories. Right. And that's how I survived, because inflation is still here. The numbers are still high. The $600 that puts you over that threshold is going to also be barely enough to cover groceries.
Yeah. I mean, but it's a mad world. But the data this week, I mean, we look at unemployment claims, we're still trending up. If we look here, for example, we're generally speaking seeing higher levels of weekly jobless claims. It's not 400,000, but if we were there, we'd probably say we're in a recession right now. But the ADP came out. This using a non-form kind of payroll calculation, establishment survey calculation here. 99,000 jobs added versus 144,000 estimated. We saw that ISM manufacturing prices were expansion, and yet manufacturing PMI is in contraction. So prices going up, economic activity going down. Blake, what do we call that?
Stagflation.
Stagflation, yes. And meanwhile, our stagflationary, I think our swim shut down. I got the blue screen of death as Roman lost his power. It's been a great morning for technology, but I got to bring up Thinkorswim.
Yeah, well, as you're doing that, I'm just going to highlight a couple things that I was looking at. Canada is our number one trading partner in the United States. People think that it might be China. It's Canada, China, and Mexico. And if you look at Canada, if we are slowing down, if we're dealing with stagflation, it means that we're also going to be buying a lot less stuff. The fact is, Canada is seeing their unemployment rate go up aggressively. They had 22.1 thousand jobs. Now they're a smaller economy, but that was in a decline by about half a percent lower than what was expected, and their unemployment rate ticked higher. That's really what we should be showing in the US as well. We should be seeing something similar. And the fact is, we expected 164,000, and we revised down last month 89,000. 89,000 is statistically negative. Mm-hmm. It is statistically negative when you look at that number. There's no way that number is a positive, good sign, because we're slowly adjusting it lower. And if you look at the revisions over just the last few months, the US is seeing revision after revision after revision, all pointing down. And when we see all of those, in fact, I think January we had one revision up, but February, March, April, May, June, and July have all been revised lower. So these numbers have not crossed the 250. 250 is roughly the kind of the margin of error. If you're above 250, you know you absolutely have some growth, but we haven't been above 250 for the last 4, if you account for the revisions.
Yeah, right.
And that last revision, 89. That's a miss. That's a major miss.
Yeah. And so you get this sense where you're lowering the previous month and to help the current month. So we have up 142,000. But yeah, I mean, you look at the unemployment rate in Canada, it's not good, right? I mean, 6.6%, well above where we're at, but we might be hitting an inflection point here regarding our employment situation. Now, I saw a note that the SOM rule, right, is now inviolate because we're now down to 4.2% unemployment rate. But if we look at some jobs numbers, I mean, this is the civilian unemployment rate from the Bureau of Labor Statistics. This is a 36-month moving average. And you can see when we cross over this is kind of reflected. It's not exactly the SOM rule, but when you cross over, you're generally entering recession. I mean, the employment situation, as you're seeing the unemployment rate rising, that's generally when you're entering recession. It's a very coincident indicator here, and you'll see this crossed over the last few months here. This is one, Blake, you were looking at the unemployment rate continuing claims. Do you want to provide us some color on this little image here?
The unemployment rate is, you can see that the red line is that one, and it's telling you the total net unemployment rate. And that's a percentage, but the total number of the people losing jobs, that's your continued claims. So what we're looking at is on the left-hand side, your numbers, your right-hand side, your percentage. So you're looking right hand for red, left hand for blue. And that blue line, even though it's slowly edging higher, it doesn't look like that big of a deal, but the roll up is what led into the net total of people unemployed. So we look at the unemployment rate, and that's people collecting and qualifying for unemployment. The total number of unemployed is a different number. It is something that is showing you how many people don't have jobs, even if they don't qualify for weekly unemployment. They could be discouraged workers. They could have retired early. They're just out of the workforce, or in one way or the other, whether they're receiving unemployment or not. And so when that one is rising, which is on the up, it's hard to see in this view here, but it's on the uptick, and it's been on a steady uptick. So every time we report that there's 150,000 people that have filed for unemployment, unless those people went back to work, people can drop off unemployment but still be unemployed. And that blue line is what that's telling you. And every time we've upticked like this, we've got one of those little gray bars kick in. I've looked through and I cannot find anything that's upticked this many weeks in a row that didn't see a recession. That's what those gray or darker gray areas in the background are.
Yeah, I mean, and this is the thing, is that when you think about what drives the economy, a lot of people talk about, okay, consumer spending. I mean, yes, consumers have been spending. We can see the data here. I mean, loans, credit cards, other revolving plans. We're trading it. We're well over $1 trillion right now. I mean, this is historically high, and yet at the same time, we're seeing the household savings rate decline substantially. And then on top of that, we're seeing default rates, delinquency rates. This is a record level right now with regards to credit card defaults at record levels. So what we're seeing right now is consumers, they're getting tapped. And this is a big problem, right? It's like, how do we continue to push the economy higher, further ahead? How do we push the market higher when the consumer is tapped? They're seeing delinquencies. We're barely making it day to day. We saw that with Dollar Tree this week. Huge miss from Dollar Tree. Is this company going to go out of business? I mean, who knows? But I mean, they're basically telling you we're living hand to mouth right now, and we're being told by our leadership, hey, let them eat cake, okay? Because inflation's good for you, right? Inflation is a sign of growth, that we're all doing well, and I'm not sure that's what we're feeling right now.
I'd ask the audience, are you feeling like you have cake?
Yeah.
Now, and I love that story.
Maybe, I guess. Yeah. I don't know.
Well, and it's one of those poor things that history is written by the victors or the very fake news, right? That's kind of what it comes down to. Marie Antoinette, when she said let them eat cake, she was basically saying let them eat the bread that normally only the wealthy could be allowed to have. She was trying to release more bread into the market, but we are kind of being treated like that from the ignorant to what it's like to have to. I mean, have any of the politicians that are currently out there, have they gone to the grocery store for themselves? Do you think that any of them really understand that they have their personal shoppers that go and take care of it? I'm not joking with that. I'm being very sincere with that. I don't think they're aware.
They're definitely not answering questions.
Yeah.
No comment. If we look at the post payrolls response, it's been bullish. If we look at the expected move from yesterday, it was about $50. So again, that's about a 1% move. Right now, we're just basically a little more than unched right now, but we are seeing a little bit of upward drift in the S&P. Not the volatile number that we probably expected to see. Probably in part because the unemployment rate dropped and we saw the, not adding as many jobs. I mean, maybe we're edging towards Fed rate cuts, maybe 50 basis points versus 25. I mean, if we look at /ZQ, we get a sense of what 30 Fed funds rate futures are. I mean,
Yeah,
not much of a move here.
not much of a move, Edge. But did you pull up the VX futures? Just because, I mean, one of the things that right before and right after the announcement, we had a pretty high volatility number. We hit 19.8 and we dropped down to 18.25. So to see a decline of about 1.5% volatility is showing that we're, as far as investors or as far as the VIX is concerned, we're saying, okay, we don't need to worry. We're going to see rate cuts. That's the way I'm reading this.
Yeah.
And the dollar got obliterated right after the announcement as well.
Let's look at GC. What's gold doing? So we're seeing gold breaking out potentially here.
Super flag.
Breaking yesterday's high, which if let's just back it out to a daily chart. We're we're kind of up in the upper ends of the range, but the top end 25.65-ish. We're looking for this to break out. At least I am. So stagflation, Fed cutting, economy circling the drain right now. I mean, again, I'm looking for this based on the symmetrical triangle, 230 to 217, 216. Let's go 15 points around it. But 227, we're looking at what? 240, right? As an area of potential target on the breakout. And the movement we're seeing today is certainly supporting that. If we look at ZB, what happened in the bond market? Oh, shoot. Computer's laggy after the blue screen of death. So we saw initial kind of pop here. Now we're seeing bonds sell off on the 10-year. I mean, is this more an inflationary kind of a tilt? I mean, are we going to see longer term notes and bonds? They're going to start to sell off here, and again, further steepen or bull steepen the curve. See that 10 and 2 uninvert, and that's what this is kind of angling towards right now.
Yeah, and whether they're deliberately trying to get it to right, because I mean we're almost back to where we see the yield curve kind of flatten out to possibly start getting a positive slope on it after the longest inverted yield curve in history. Yeah. Is that their push so that they can say, "See, we're not in an inversion anymore"?
Well, I mean, it certainly helps banks, right? I mean, if we can uninvert the yield curve, I mean that prospectively helps banks. I mean, the 5 years at 3.5%, the 10-year 10 years at 3.7%, TYX, the 30-year is now at 4%. So we are starting to see again that uninversion, and we got to get short-term rates down. The way you get short-term rates down, like the 3-month T-bill, is for the Fed to cut rates. And so certainly seeing that the curve is steepening out. It's called a bull steepening. And again, that's reflective of what? It's generally reflective if the Fed's going to cut rates of entering recession.
Yeah. And Rosario says, Brandon Blake, you think that at this point, the Fed has made, once again, a policy mistake by staying restrictive too long. I have a comment to that, but I'm just curious whether you want to take a stand on that one as well. Did the Fed make a mistake by, let's make sure that we separate the two, a policy mistake by restricting rates too long? So I think we can all agree they've made lots of mistakes.
The policy mistake is the existence of the Federal Reserve, but within the construct of allowing them to exist, giving them a private bank monopoly power to print money and enforcement by a point of a gun on the part of the government, that's fiat currency, right? But the policy mistake was, well, I mean, look, so for example, well, I'll just use IRX here as a proxy for the Fed funds rate. And IRX. Oops. He wanted to do IRS.
IR Blake.
But the policy here, right? They raise rates from basically 0 to 5.25%, 5.5%. How do they know what the rate should be? I mean, this was a record increase in rates in such a short period of time. And yet at the same time, they were funneling money out the back door through their programs, right? Bank bailouts, again, the reverse repo. So from my standpoint, before they did this, they probably should have sought to reduce the size of their balance sheet. Okay. But what they wanted to do is what? They wanted to curb wage growth. That was admittedly what their goal was, right? They called mission accomplished on that front. And so this was a policy mistake, just as this was a policy mistake. Pumping $5 trillion into the system is a policy mistake. And so it's just mistake after mistake after mistake, thinking that they know what the interest prevailing rate should be. Now, if we think about from a policy perspective, traditional, yeah, we've had negative real rates with let's say, for example, TNX CGI. We'll bring this one up here. The 10-year expected inflation rate was down here, 2.6%. The 10-year treasury yield was a 5% for part of that time. So we're talking about negative real rates. That is restrictive. This has been a very long period of time with restrictive rates. And the last time we can point to this kind of restrictive rates was going into 1929. So I'm like, so yeah, I mean, if we look at just basic policy history, like patterns and what they've done in the past, yes, this is different.
See, I knew if I asked you first, you would go for a second there.
I would go long, yeah.
So my only,
how much is Brandon gonna let me say?
So my only comment to that, and I won't get into my views entirely. My question is cutting rates, does it help the consumer? And my answer to that is at this point, no.
Yeah.
If we're already tapped out, if we are at almost $1.1 trillion in consumer debt, credit card debt alone, not counting housing. If we're at record defaults, if they give you 50 basis points lower interest rates on your yield spread, is it going to change how you spend?
Yeah.
If you are maxed out on your credit card and they go from 28% to 27.5%, is it going to be noticeable if you're already maxed out on your credit card? And I just don't think it's good. I think it's not going to happen. It's not going to help. And even if they cut it down to 0%, even that I don't think will help the consumer enough without seeing recessionary behavior.
If they cut it to zero, that just tells you, yes, we're in recession, right? And it's not good. So, I mean, we're teetering that direction right now. And frankly, if you look at, for example, we'll skip over working stocks, we'll get earnings surprises, but when you look at cash on the balance sheets of companies as a percentage of assets, I mean, we're basically near record lows. Companies don't have cash. And we've seen the trend in buybacks come in a bit. So, I mean, look, spending on the part of companies is starting to come in a little bit. Spending on the part of people in general, we're starting to see the inability to pay our debts. Cutting rates is not going to help us in that regard. You've got to have the debt wiped out, right? That's what recessions do, is people declare bankruptcy and other factors to try to get off of the debt side of things, and companies do go out of business. I mean, we look at some earnings or surprises today. Zscaler rather. We got Hewlett Packard Enterprise, Dollar Tree. That was a big one. Broadcom, AVGO.
Yeah, in case you didn't know, that wasn't just red, green. That was actually how they missed or beat their earnings. So
yeah.
Yeah.
But Broadcom beating, and yet the stock's down pretty precipitously pre-market here, right? Mm-hmm. Dollar Tree, again, that was disastrous this week. I mean, just showing the consumer is just strapped at the moment. CPRT, is that Copart? Yeah, Copart, mm-hmm. Big drop. So what does Copart do, Blake?
Yeah, Copart is they're a parts company. So I'm trying to remember all the businesses that they're part of. It's kind of like a
online auctions, vehicle remarketing.
Yeah, it's primarily, the main thing is they do the auctions, and so like if an insurance companies, they sell their cars through Copart. If they've paid out, if you have a loss, so that's primarily their big business. I don't know if that's what it says here, but I'm just reading your thing. Yeah. But that's how I know them, is so like if you have a car accident and they take your car and they're the ones that auction it off or sell it online or sell it for parts or sell it as a runs but doesn't drive on their website. So it's it's the insurance company's ability to recapture some of their losses when they pay out from an accident.
And we're seeing, I mean, auto prices, that we're seeing struggles there.
CarMax.
Zscaler. You got Zscaler in here. Big drop yesterday on its earnings. So I mean, look, I mean, even companies that beat doesn't necessarily mean the company stock's going to go up. We're looking at outlook too. I mean, there's a three-part process to this, right? Do they beat revenue? Do they beat earnings? Do they raise their guidance? And does the stock go higher? All these companies, and yet we have over a 50% beat rate here. Well, let's look at HPE, Hewlett Packard Enterprises. They're down as well, off of a beat.
Yeah. So I know we're running down on time because we got to let Don take over in about 9 minutes. So I'm just going to, I covered this in the video yesterday, so I'm not going to spend my time on my bears and bulls. I don't know if I want to highlight yours. Ally, Capital One Financial, and really retail are bearish for me. But I'd love to see, you know, what you as the audience and you, Brandon, what you're seeing as far as your bears and bulls are concerned. Just ask you to go back and watch my video from yesterday if you want to see my view on Capital One Financial and Ally.
And I'll say on DraftKings, I mean, you saw yesterday, or sorry, 2 days ago, a lot of option activity in the airline space and had a nice move yesterday. And these stocks typically have higher short interest. DraftKings typically has higher short interest. So if you're getting a squeeze here, we might have further follow through. I'm still bullish on gold. Again, we talked about the target already. PayPal. You might look at we kind of have been on this for a few weeks now. You might be taking profits up here. But Blake, I'm going to go short-term bearish on XLU. If longer-term rates start to rise, we're oversold. We're overbought in the near term. So
I think
I'm
we're overbought in the near
pullback.
term, but I can't fade it yet. I wouldn't take a short on there.
So I think it's just a near-term pullback, kind of an in-out type spread on XLU, XLF as well, financials.
Now, financials, I think, is a different story. That took out an entire week and a half of data. So XLF and therefore the banks and Ally and Capital One, and you know, they're all for me bearish. XRE as well.
Target has some bullish option activity. We're looking for kind of a break of 155. Looking at retesting up here. So let's look at some stocks. What do you folks got? Anything in the chat, Blake?
You know, I was just looking to see if there's anything in the chat. I wasn't clear enough on my call. If there's any symbols you want us to pull up here in the next 6-7 minutes, I'd love to see it. Calvin says if taming inflation was the goal, my grocery gas are almost double the price pre-COVID. Yeah, and that's fortunate, Calvin. Really, even though the gas prices and oil prices have come down dramatically, you're fortunate to have it only be double, because the data would show you should be about 220% on top of. So it should be closer to 3 times what you're originally at. Coinbase.
Now my son's in Taiwan and he's like, man, it's like food prices are cheap. So this isn't a global issue, right? This is some policies we're doing here that's causing prices to go up. I mean, it's about 40%. Food's about 40% of what is it here right now. Even if you go to Walmart, it's cheaper. Or sorry, go to McDonald's, it's cheaper. Anyway, Coinbase. You know, from my standpoint, Coinbase is a leech on the system. They're centralizing decentralized finance. But I get it. People that, you know, want to exchange and stuff and buy, they may use this product. But look, I mean, this is not exactly the environment that's going to be strong for Bitcoin, right? If we are seeing an unwind in technology and other higher beta stuff, I mean, again, you know, Bitcoin has tend to follow technology. You look at BTC here as well, at a point of support. But Coinbase, yeah, you're at support. We're seeing some pretty significant pressure here and on volume as well. So, I mean, we're testing support. We kind of broke below it yesterday, that low. I don't know, what's your thought, Blake, on Coinbase?
Yeah, no, I'm with you. And, you know, you and I are going to be going toe to toe as far as on our view on Bitcoin in
Join
Scottsdale.
us virtually or in person, right? In Scottsdale next week.
So we'll battle it out. You know, I'm not a fan of Bitcoin. And so I think Coinbase only will be weighed down by its own albatross, except the albatross is bigger than it is. So there we go. What about GE? What about a conglomerate like GE?
Well, and we're seeing the manufacturing this week is in contraction, right? GE's we're losing manufacturing jobs. So the issue with GE here is we've lagged the market for months. We've had significant sell-offs on higher volume back here after an earnings jump, right? So we have this almost potential for an exhaustion type gap. And then we broke down hard a couple of days ago. So we've got some support levels in here down at around 157 and maybe 150. But yeah, this certainly looks like a topping type pattern on GE. Maybe we break to a new high, but I think the lows might be more likely to be taken out. What's your thought?
Yeah, I know. I think you're on GE. You're right on the money. I don't think we're anywhere close to being done. I'd probably put a little bit higher, maybe 154, 155 before I'd even consider looking at selling puts on it. But it's got to stabilize a little bit higher. I don't expect that gap down to be retest. I expect where the key support level was about 154. So,
on balance volume is still, I mean, we're still kind of in the range here, right? We're not exactly taking off, but we're not seeing there was any significant volume divergences, which is good because we had some big volume on the upside throughout this phase right here. So it looks like we were in a phase of accumulation, and now we're just kind of waiting and seeing, and now we'll see if do we distribute or do we accumulate. And again, looking at the breakout of above 177 or a break of support down here, 155 would give you a sense of where we're going. Because right now, again, the trend is not great for GE. We got some Lulu. Oops. You know, what do we think about high-end stretchy pants?
I don't think we're done. I mean, sometimes you wear stretchy pants, but otherwise, I like the bounce, but it doesn't look like it's going to be into an uptrend yet for me. Yeah. Yes, we widened out. This is what I was talking about a lot over the last week is any widening pattern, you have to have a follow through to make a new trend. So that means the trend's probability is to the upside after that widening out, but you've got to get a higher high for me. And I like your little trend line there, but I've got to get a higher high before I trust it.
Trend across the highs, across the lows. So we're kind of broadening out a little bit here. But again, we see the break. Again, just look, the company did actually beat. But again, I think right now this is the point in the S&P where you probably just kind of sit back a little bit. I mean, like when you look at the VIX, I mean, the VIX is coming off today, but man, we could easily start to shore up here. I was surprised at how quickly the VIX went in backwardation off of this sell-off there. That's a more of a bullish sign. So again, we'll see, but we might just get a little rally out of this and then roll back over again. So I think the risks are to the downside. But again, if we're going to start to price in 50 basis points, we could retest our highs again in the S&P. But right now, what we saw this week was skew was going crazy. Ran up to about 163. We're backing off right now, but the tail risk is very significant in terms of the downside potential. But high skew also means you're going to have a higher frequency of up days, small up days. And so don't be surprised if you get some up days in here, but the tail risk right now is as high as it's been in ever, right? In terms of the level of skew. So it's a big deal.
Yeah. Well, and we're down to our last minute. I know we talked about bonds. Let's throw in TLT really quickly as kind of our parting one, because it is about bonds. It is about the government and rates. Is this going to be the breakout?
Look, if the Fed is going to cut rates, I mean, I've been on this for a long time. The Fed's going to cut rates. We talked about some call spreads in here before, but yeah, if they're going to go to ZIRP, well, there's huge upside here because the duration of TLT is much, much bigger. The effect of interest rate changes are much bigger on TLT than something like SHY. So if you think we're recessionary in terms of posture, then TLT as a long-term investment could be pretty decent. SHY would just be playing more off the cut-in rates, and it has a lower duration, lower sensitivity to interest rate changes. So the upside's not as great, but probably more sure.
Yeah, and Hot Pepper commenting 56 trillion or 56,804 US funny money on ASTS, I'm assuming.
I'm not sure.
I'm not sure what that one means. So we're going to have to wrap it up here and give way to Don Kaufman. He'll be coming on to take you into the market open here momentarily. Have a great day. We'll see you back in the main room. Brandon, thank you as always. Thanks for driving. I like to sit over here and just watch him drive. He drives really well. Freak. He drives really well.
I'm a very good driver. I can also count toothpicks.
That's right.
Like nobody's business.
Okay. Thanks, everybody. Have a great day. We'll see you shortly in the main room.
Have a great one. See you.